Welcome, everybody, to our Leaders in Housing Counseling call. We're going to have a packed agenda, and so we're going to dive right in. Our plan is to talk about the national funding situation. We have Elaine Weiss from the Low Income Housing Coalition to give us the high-level view and some courses of action we can take. And we'll have Matthew do a deeper dive on housing counseling funding and some specific things we really need you all to engage with. But we think there's, given the difficult environment we're in, we have real opportunities to have impact. A good part of the call will be devoted to the RESPA rules and how they impact housing counseling, and we've got some expert opinions about the court decision and how it will play out in fee-for-service relationships. And then we're going to, the third topic will be about an active lender agreements that New York Mortgage Coalition has negotiated. We have Rebecca Sen, the executive director there, to walk through what they're using and using in place. And she was kind enough to share the document that they're using, which others will be able to see. We sent it out right before this call on the email, the listserv. And then, of course, a plug to join NHRC. So let's dive right in. I know that you have limited time, Elaine, but thank you very much. Your organization is doing excellent work on the budget. Please tell us your high-level view of what's happening and what we can do.
Well, thank you for that introduction, and thank you for having me. So as far as fiscal year 18 is concerned, our long national nightmare is over. Congress has finally passed the spending deal last week to lift the Budget Control Act caps that have really put downward pressure on funding for HUD programs. These caps were put in place during the whole, we need to take care of our national deficit. We're going to put these artificially low caps on spending for defense and non-defense funding, and it's really hampered funding for HUD since 2010. Funding has just gone steadily downward with these caps. But Congress has come to this realization that these caps are unworkable. So the last several years, they've reached these 2-year agreements to provide some relief from these really tight spending caps. The last agreement expired last year. That was the last year that there was that relief. So they, again, had to negotiate to lift these spending caps. But unlike the previous years, there wasn't a willing partner in the White House to help negotiate these caps. Fortunately, members of Congress were able to work through those issues, and they were able to raise funding for non-defense programs by $63 billion in fiscal year 18 and $68 billion in fiscal year 19. That is a lot of money, but it still doesn't reach the funding levels for non-defense programs when compared to 2010. So while we were happy to get such a deal, it just really shows what these spending caps, what impact they've had on funding for programs since they've been in place. It's also important to note that of that $63 billion, some of it's already been earmarked to, combat the opioid epidemic. Some of it's for infrastructure. Some of it's for homeland security. So it's not a bucket that doesn't have strings attached to it. So right now, one of the actions that we can be taking is reaching out to the leaders on the Appropriations Committee. Right now, they are working to determine how exactly they're going to divide up that money among the 12 different buckets. Well, the 11 buckets, because the 12th bucket is the defense spending bucket. So that doesn't get the part of the $63 billion. They get their own funding. But this week they've been meeting to figure out what their funding priorities will be, and we need to work to ensure that HUD gets its fair share of these additional resources. In the last spending deal, HUD did not get its fair share compared to other agencies, save for HHS. They were both at lower percentages when compared to other agencies. So it's really incumbent upon us this week to be calling not only our lawmakers, but those folks who are making the decisions as to how they want to spend this additional money. So that's fiscal year 18 in a very small nutshell. So moving right along to fiscal year 19, President Trump released his budget request on Monday, and as we all expected, it is just as terrible as last year. It is proposing massive cuts to the HUD budget. In the initial budget request, it proposes $8.8 billion in cuts, or 18.3% compared to 2017 enacted levels, and that's not even factoring in inflation. They added an addendum after the spending deal was reached over the weekend, and from that addendum, they add in $2 billion back in. So the total cut is $6.8 billion, or 14%. It proposes axing or eliminating programs that they did last year: the Housing Trust Fund, CDBG, Home, the self-help housing program, Section 4 capacity building. So really terrible cuts. Oh, and of course, the new thing this year was they completely eliminate funding for the public housing capital account. Just gone. They are really, this administration is really abrogating their responsibility towards public housing, and it is really just putting the onus on state and local governments to maintain public housing. It also would result, we estimate, in the loss of 200,000 housing choice vouchers. It underfunds pretty much every program. And not only that, it proposes really terrible policies, changes to rent structures, allowing not only public housing agencies, but also private owners of Section 8 developments to impose work requirements. So all in all, just a really terrible budget. Specifically for housing counseling, it proposes even less than it did last year. This year it's proposing $44 million for housing counseling. Last year it proposed $47 million. And to compare, the Senate has proposed, I'm looking at my budget chart real quickly, the Senate has proposed $47 million this year, and the House has proposed $50 million. So I'm sure that there will be, some sort of agreement between the two of them as to what the final funding level will be. But clearly the president doesn't, he, like all HUD programs, he has no problem cutting from housing counseling assistance for folks. So as far as actions we could take on that, we are having a webinar next Tuesday at 3 p.m. that will go more into detail about the different budget cuts and policy proposals being put forward by the administration. You could find that registration link on our website at nlihc.org. We are also circulating a sign-on letter asking members of Congress to ensure that affordable housing programs get the highest level of funding possible. We also have another sign-on letter asking Congress to reject these really harmful proposals to increase rents and impose work requirements as a way of, they talk about it as trying to get people to become self-sufficient, when we really know it's just a way for them to make up the money that they have spent on tax reform. It's just one big scam. And then in May, we will be holding our second annual National Housing Week of Action. Last year we did it in July. This year we're doing it the first week of May, so May 1st through the 8th. If you'd like more information on that, you could visit ourhomes-ourvoices.org, or you could reach out to me and learn how you can organize an event. We are getting this year's Week of Action off the ground now. We're going to start putting events up on our website. When you start planning an event and you want to put it on the website, you don't need to have all the details set in stone right now, but we could just put it up that you're planning to have an event, just so people know that you are, and having a point of contact so others in your area can know who to connect with and also participate in that event. So those are some of the actions that you could be taking right now. We're also getting into, now that the president has put out his budget request, members of Congress are going to be wanting to get funding requests from folks. So you should definitely look at your members of Congress on their website, whether they're posting that sometimes they'll have like web portals of taking in requests for how much money people are looking to get for programs, and they really do care about input from folks on the ground in their districts. If they don't have that information online, you could always contact the office and see how to go about doing that. But that's definitely something that you could be doing as well.
Elaine, could you actually, just going back to the Week of Action, could you talk a little bit about some of the events that were done last year and what
Sure.
kind of give folks an idea of what they might be thinking about?
Yeah, so the Week of Action, we had over 60 events nationwide, and they really there were a whole variety of events. We know that people have different capacity to pull off different types of events, so we had some folks who were able to pull together a rally while some others, did a letter writing campaign within a community. So they used the community room and all the folks came in and used these postcards that we had created for the Week of Action and wrote to their members of Congress of, why their homes were important to them. We had somebody do a photo booth. So it's really flexible as to what you want to do and also the message that you want to share or elevate in your event. We have an overarching message, but here in DC, I am not the one to tell you what message that you want to share with your congressperson. You're in the best position to know what speaks to them. So we're definitely trying to make it as flexible as possible and as tailorable as possible for people to participate.
I would just throw a quick plug in. We've for a number of years have been really trying to connect members in their districts with local counseling agencies. So if folks are feeling ambitious, trying to organize a site visit with a member is an excellent way to kind of get them invested in the work that you're doing, and those always make a huge difference.
And we purposely picked a week where members of Congress will be in their district so that people like you could invite them to events, because we know just how much more of an impact these events have with people inviting their members of Congress to go and see how awesome developments are and the work that's being done. They need to hear from you. They hear from us in DC all the time. They're like, oh, you again? So it's really important that they hear those local voices, and that's really what the Week of Action is about. It's about local action and people speaking directly to their members of Congress. And given that it's an election year, now's the time to really get out there and make our voices heard and really push this to be an election year issue.
Excellent. Thank you very much. Really appreciate this. Good work. And we'll post more as we do it. And we already did post the letter, so we may do that as a second time to encourage people to join. I know last year we had a very good showing from the housing counseling community on the letter.
Yeah, and we really appreciated that. And we had we had close to 3,500 groups sign on to that letter. So we're definitely looking to do just as well, if not better, this year. So we appreciate all the help we could get.
Great. Sounds great. Let's quickly pivot over to the housing counseling situation. And Matthew?
Yeah, and Elaine really covered a lot of what I was going to say. So I'll just pretty quickly say, so Elaine talked about we reached the budget deal, so now they have more money to spend. They had previously the House and Senate had each written these bills. They're now going to find out in the near future how much more money they have to work with, and then kind of do the back and forth and start plugging it into, they're going to have different priorities as to where the money goes. We're working, especially with Congressman Dent, who's, as folks on the call know, has been our biggest ally and supporter, and is on the Appropriations Committee and is a chair of one of the subcommittees, and work with him to try to restore funding to at least the current level of $55 million, and to push for even an increase to up to $60 million. We're also going to be reaching out to folks, other folks on the THUD subcommittee, try to get them to weigh in with Chairman Diaz-Balart. But that's kind of where we are. The budget deal was reached last week. It gave them essentially 6 weeks to write these 12 new budget bills. We've heard from the folks on THUD that they can get their bill done very quickly once they had the caps lifted and had a number to work with. So we are going to start kind of a full court press now. We have been waiting all this time to get these higher budget numbers, and now we're going to try to translate that into additional funding for counseling. On 19, Elaine had already touched on the numbers for counseling. The administration proposal was for $47 million. I think the one thing that's important to note, last year when the president's budget came out, folks on the Hill essentially said, this is dead on arrival. I mean, just to point one thing out is that we just reached these budget caps, the budget deal for 18 and 19, which significantly increases the amount of money there is to spend, and the administration's budget only spends a fraction of that additional funding. They come in way under the caps. So it's just not. In my estimation, it's probably also going to be kind of dead on arrival when it hits the Senate, eliminating programs like CDBG. It's worth noting that it eliminates NeighborWorks and cuts funding for housing counseling. So we are now starting to do our work on 19 at the Hill level. We are in the same way that Elaine just talked about their sign-on. We're going to be coming out with a sign-on letter hopefully today with specific asking members to include in their budget requests that they send out to appropriators funding for housing counseling, increased funding for housing counseling in light of the higher spending caps. So that's the letter we do every year. We generally, I think in the past we've gotten up to close to 500 or so signatures. We're going to have a relatively short turnaround. The fact that 18 and 19 are happening kind of parallel is making things a little bit complicated this year, but we're going to get that letter out today, hopefully, and have a pretty quick turnaround. So folks should be on the lookout for that.
Well, and I think the other action item is that now is the time that House and Senate members send to the Appropriations Committee their requests for funding, what their priorities are, and so we will. So it's really, really important, and Matthew will give you some guidance by email about reaching out to each of your members that you deliver services in, asking that housing counseling be included, and we're setting a target number, 65 million. What's your call, Matthew? Does that?
We hadn't landed on a number, but I think that'll probably be it.
Okay, so. But the point is that if we can get this on as many letters as possible, and I think last year we were saying, the real emphasis should be on Republican. This year, I think we're saying it should be on both Republican and Democratic. But that this is right now, more of these that get into the queue, especially on the Republican side, that's really valuable. Does that cover it? Good. Okay, so we're going to jump on. I have to say we're running a little over time because it's important stuff, so we may end up, the call may go past our normal full hour and may go a little bit longer because we have a lot of ground to cover. So let's move on to RESPA. So we've talked about this several times, about the impact of RESPA enforcement and regulation on fee-for-service relationships between lenders and housing counselors. And as I think we've said before, it's become a minefield, not necessarily because of what CFPB has done or not done, but because of anxiousness among the lenders. There's been a lot of good work that's been done, and the Homeownership Preservation Foundation and We Need SUS both had did kind of deep dives on the legal implications of RESPA under the CFPB and how we could interpret all that. There's been a series of meetings. There's been a lot of thinking about this, but the recent court decision around PHH, which PHH Mortgage Company, which raised part of which was around the issue of a different kind of fee-for-service relationship, has impacted all this. So with that opening note, Matthew, do you want to give us a quick overview on what the legal decision was like?
Yep. So I'm just going to do a quick kind of background, then talk about the decision that came out a couple of weeks ago, give a couple big picture takeaways, and then kick it over to Kent, who I think is going to elaborate on some of the things. So just by way of background, so the PHH case involved what's known as captive reinsurance. Folks may or may not know what that is, but it's not really important. The reason that PHH implicated housing counseling is that in that case, then Director Cordray had essentially changed how CFPB interprets RESPA, and specifically on the prohibition on receiving payments for referrals. So it had long been understood that there was essentially a safe harbor under RESPA as long as there was a payment that was made for a service that was actually provided. So in the PHH case, Director Cordray had essentially changed CFPB's interpretation. The impact on housing counseling was that lenders read that new interpretation as potentially potentially putting a fee-for-service arrangement between a lender and a counseling agency on the wrong side of the RESPA referral prohibition. So it's been kind of working its way through the courts. What we had 2 weeks ago was a decision from basically the full DC circuit. So all of the judges, I forget how many there were, but 15, 16, 17 judges all heard the case together. There was basically two issues that they covered. The first, and the one that got all the attention, was this question about the constitutionality of how CFPB is structured. On that, and this is kind of an aside, but they basically said that they reversed the previous decision and said the way that CFPB is structured is constitutional. The other thing that the full DC Circuit Court said was that on the RESPA question, we're reinstating the previous court's decision on the RESPA question. So going back to what the previous court had said on RESPA, they had basically said, first, that the CFPB's interpretation of RESPA was impermissible. They said that RESPA clearly creates a safe harbor for as long as there's a payment that was bona fide, and bona fide, they said, means reasonable market value, and that the payment was for services that were actually provided. And then the last thing they said was, even if the way CFPB had interpreted RESPA was permissible, that due process requires that they essentially give some form of notice to PHH to let them know, hey, this is how we're interpreting RESPA going forward. The court said you can't do that in an enforcement action like they did against PHH. They need to know that essentially you're changing the rules of the game. So that's the impact of what happened last week. That's kind of the technical legal takeaway. And again, Kent is going to elaborate on some of these things. Just a few kind of big picture takeaways. One is, I think this is a very positive decision for housing counseling and specifically for the prospects of lenders getting comfortable again with entering into fee-for-service arrangements with counseling agencies. I mean, it essentially reverses that CFPB interpretation from Director Cordray that had kind of triggered the concern amongst the lending community that they may end up on the wrong side of RESPA and the wrong side of CFPB, and kind of reinstates the understanding that had been in place previously, that you can receive a payment for a referral as long as it's bona fide and as long as it's for a service that was actually provided. Just a few kind of caveats. So the case does specifically apply to captive reinsurance. I do think, though, that the reasoning seems pretty broadly applicable to other situations, such as a fee-for-service arrangement between counseling agencies and lenders. I know Kent is going to talk more about this, but a big caveat potentially is that the case is only binding in the DC Circuit. I'll let Kent kind of go into what that means. And just the biggest thing I think is the most important thing the most important takeaway from this is going to be, how does the lending community interpret the court's decision here? The question was there was never concern that CFPB was going to start coming after counseling agencies and saying, this is you're getting a prohibited kickback. It was that CFPB's interpretation had caused alarm in the lending community, and they were kind of spooked and were fearful about entering into fee-for-service arrangements. So the ultimately what's going to matter is do lenders read this decision as kind of a green light to go back into doing the fee-for-service arrangements with the lenders. So I'll kick it now to Kent, unless Bruce, I don't know if you want to add anything or if we want to go right to Kent.
No, let's go to Kent.
Well, sure, Matthew didn't leave anything for me. I think you hit all the key points. Maybe I can try to spit them out in a little bit different way. And so, thanks for introducing me and just having me on the call, guys, too. For those that you don't know, I'm the general counsel with the Homeownership Preservation Foundation. I, of course, work with David Berenbaum, and this has been an issue that's really been at the forefront for us over the past couple of years. The essential RESPA question is a lender funding pre-purchase housing counseling going to be considered an illegal kickback under RESPA? We think the answer now is very clearly no. Historically, the answer was very clearly no, as Matthew already touched on. It was considered a bona fide service. There was some fair market value calculations. It very clearly fell within the safe harbors in RESPA Section 8C. Now, then we had this PHH enforcement action by the CFPB. And then it raised the question of, again, is funding pre-purchase housing counseling an illegal kickback? At that point, lenders were starting to say, well, maybe it is, because the CFPB just changed the rules on us. We don't know what the rules are. We don't want to take any steps that would even arguably be considered, inappropriate. And so that's when we all got to action. And, a lot of us really got to work talking with the CFPB, getting some informal guidance from them. And in that strange place, when there was maybe a potential violation, we got some guidance from the CFPB on what to do and how to move forward. And then, as Matthew just summarized, over the past couple of weeks, we've got some even better clarity from the DC Circuit, essentially saying that the CFPB's approach, their interpretation, taking an objective standard and making it a subjective one, was inappropriate. Now, Matthew, I think he already kind of covered the caveats. It's possible this gets appealed. We don't think it will. The CFPB today is much different than the CFPB when this original enforcement action happened. There's also the fact that Matthew mentioned that, technically this is only binding precedent in the District of Columbia, right? Again, I don't know that that's really going to have much of an impact on us. As Matthew said, this is ultimately about the lender's risk and what they think they're going to be exposed to by funding our services. We've got, through our informal guidance, we got some pretty clear guidelines from the CFPB, and we also got some nice assurances, basically just saying, listen, we're not looking to enforce against housing counseling organizations helping consumers get into sustainable mortgages. That's a nice takeaway that we don't have to lose, because a lot of those people, believe it or not, are still at the CFPB. I know a lot of people aren't at the CFPB nowadays, but a lot of those folks still are. And so, in terms of next steps, just to, again, echo what Matthew said, the way we are approaching this is we are hanging on to some of the best practices that the CFPB recommended. And a lot of them, these are pragmatic recommendations on how to contract with funders. Things like, when contracting with a funder, we're not going to guarantee that we're going to refer them back to a specific lender, right? We serve the client. We're not there as as referral sources. We're not selling leads. We're counseling clients, helping them to get into sustainable mortgages, right? And so those kinds of best practices that were put in place through the CFPB and informal guidance, we're going to try and hang on to some of those because they help us provide a better service to the client. As far as looking at RESPA and regulatory risk, we're gonna defer to the lenders because again, this is their risk, not ours. We don't really have to worry about the CFPB coming after us. We just need to make sure we're performing a good service, serving our people, and we need to help them meet their own regulatory mandates. And so the more risk averse groups, they might still want to be more careful about this. We expect that there's going to be a lot more risk tolerance around this issue in light of the DC opinion. So that's all I've got. Thanks, everybody.
Well, good. And so one quick question for the lawyers here, which is that, so the HUD handbook says that you have to refer to at least 3 lenders. But when you defined what was RESPA acceptable, that standard did not come up. The standard was it had to be a bona fide relationship. It had to be with a reasonable mortgage value, market value to the service provided, and that the services actually were performed. So in court, we will still have the minimum of at least 3 referrals because that's a HUD standard, but it's not a RESPA standard. Is that correct to say?
I think that's a great way to put it, Bruce. Right. So HUD, for those of you that don't know, HUD used to enforce RESPA. Through the Dodd-Frank Act, when the CFPB was created, the CFPB took over enforcement for RESPA. So it's really interesting that, and really glad you raised this, Bruce. We have a housing counseling guideline. We have some standards that HUD wants us to abide by, and of course we want to meet those standards. They're our regulator, right? But as it pertains to RESPA, HUD doesn't have any authority. And so when it comes down to minimum numbers of referrals, I think you need to take a pragmatic approach, right? That's what some of these issues really come down to. I would say in most cases, it's a really good idea for all of our clients to be able to shop around. And I think it's a pragmatic approach to say, as a rule, we are gonna provide at least 3, maybe even more, right? Or maybe if we follow the informal guidance from the CFPB, they provide a really pragmatic rule. If you provide a list, make sure it includes a mix of groups that you're contracted with, and maybe even groups that you're not contracted with. Maybe include some local lenders. So to get back to your point, Bruce, we do still have this HUD handbook, which is instructive and we want to follow, but it's more for making HUD happy and less about complying with RESPA, if that makes any sense.
Yeah. And this, and just to caveat before we ask this question, it's a little bit difficult to deal with specific questions on this. When we spoke to CFPB, they were very, they would give us kind of guidelines, but they were very careful not to draw black and white lines. But Ken, you kind of covered this, but may want to just weigh in on this. Someone asked if we have 3 lenders who offer fee for service, should we include one that does not? I think you just kind of touched on that, but do you want to comment on that any further?
I think every group might handle this one differently. And I can see both sides to it. Now, when the CFPB provided their informal guidance, and I don't want to get too into the weeds on the regulation, but when the CFPB provided that guidance, they were very careful to avoid RESPA section, I think it is 8C2, and that's the safe harbor provision. Instead, they looked at a provision under 8A, which the question was, is a referral being provided? Whereas under 8C2, is the referral okay because it's a bona fide service. When the CFPB provided that guidance, they said, if you follow these steps, we don't even consider it a referral, right? And so if you include multiple lenders If you're not agreeing to any mandates that you will refer clients back to lenders directly, if you're not promoting one lender over all the others on a regular basis, and if you're providing a list of lenders that a consumer can then reach out to, and at least one of those lenders is not contracted with you, well then we at the CFPB don't even consider that a referral. So it's a complete non-issue under RESPA. And so I think every group's probably going to take a different approach on that. The approach that we're taking is we're including in our lists of recommended lenders, we're really trying to include at least one community-based lender, whether that is a CDFI, a community bank, maybe a local credit union, a group that we're not contracted with, but that we have reason to believe could provide some really high quality service to this client, or maybe if that client has their own relationship with a community bank, we can say, hey, talk to them too. And so we are moving forward to include that kind of recommendation, at least at this point. That may change. So I feel like I'm getting a little wordy in my response, but to answer your question, Bruce, I think it depends, and ultimately depends on each group's preferences and where they want to go with it.
Okay, so I think that's very helpful. Why don't we pivot now to experts in the field? What does this mean for our housing counseling agencies? We've touched on this already, but it'd be great to hear the perspectives. So we have Lot Diaz from Unidos US and David Berenbaum from the Homeownership Preservation Foundation, both of whom have been on the calls before and I think are well-known figures in our field. So Lot, what's your overall view of all this and how it impacts our opportunities?
Thank you, Bruce. Hello, everyone. Great presentation on the regulation. It's one that's been, as Kent mentioned, bothering many of us for a couple of years now, because we could see when we got out of the crisis, the ability to facilitate mortgages with clients seeing through our networks. This could easily have become a barrier, and it did, I believe. So now that getting a little more clarity, it's not fully clear, but I think I tend to agree with what Kent and Matthew are saying. The legal impediment is much less stark for legal departments of lenders than it was before, simply because with the C2 provision and a couple other standard things that nonprofits can do with their agreements, it kind of really sets a fair market price for their service. So what I'm going to focus on is, and what we've been encouraging in our network as best we can, is to try to create fee-for-service agreements with their local lender partners. In most cases, the regional, or the national banks particularly, have not been heavy in originations in this area, with a couple exceptions. And so much of the work that we've seen in our local agencies, and by the way, we're a HUD intermediary, so we have many local agencies working in different markets, is really to know and capture those products that they know their families are using, will use, and are good for them, and make a pitch to that lender to support their work and enter into agreement. Related to, so the idea here is, if you've got three lenders, we were hoping at our level to throw a national lender into that mix, simply because we wanted to make it easier to get the three lenders in each market, because we're kind of abiding in most cases. There is some exceptions to this, but the three lender rule is for sure a strong one for us. Not to mention it's HUD's on, the practice that HUD is currently has in its regs, but it's also good practice. And our feeling is our local agencies can find three products that our clients are using well, and then to target those lenders as we can not only if you in a partnership will help prepare those families, you're going to get all the benefits of pre-purchase counseling, et cetera, and argue those for those local lenders. One thing I will say, kind of on a lot of broader market, the market is not good for LMI lending right now, simply because cost of lending, for those who have been following it, has been rising steadily since before the crisis. And so now there's many are arguing it's absolutely uneconomic to lend to that LMI community because you just don't make enough money off those loans. There's some squishiness in that argument generally because what you include in cost, and I mean there's just lots of squishiness there. But one thing is clear. That is an impediment for many of the lenders. If they can't see the profit margins, they don't pursue that market as aggressively. And you see that with many institutions. But what is also clear, and I've heard this from several lenders, is that there's not enough loans in the system, meaning that the purchase money mortgages, the ones where families are coming into the market, those are hard to identify, right? They're just hard to identify because people's aversion to credit, people coming out of crisis, people not trusting banks. There's just several potential impediments to that. And one thing housing counseling agencies can provide is an individual who's prepared for home ownership and works with a family over time to get to that place. That is, in this current market, a very valuable commodity. And so one of the things we're going to start pushing out to our network is that, we want to add loans into your market, but to add loans into your market, you need to support us through counseling agreements of a sort. And, it's kind of a different conversation. But the thing is that the point is that there is value added that counseling organizations can bring by focusing on bringing borrowers who are not into the system, because there's not enough of those, and there's just not. I mean, marketing to particularly the market that most of the communities that our agencies serve, it's just not high on the priority list of most lenders. And so I'll end by just saying that I think was very happy to hear about the decision. I'm waiting to see how the banks are going to internalize that. I still think it's a great opportunity. I mean, to capture some of the information here is really critical because when you do deal with local lenders, they may not be as up to date as you are here hearing this. So you're going to have to walk them through some of this stuff, undoubtedly, depending on the lender. And but the point I'm making is that you're going to be preparing families, you're going to be incurring staff time to get all that done. It's going to go to the benefit to the lending community. It really is important to find ways to build those relationships with them. And secondly, you're providing something that the market really needs, and that is a borrower who's not in the market yet. And if you bypass a brokerage arm, meaning that they go directly to the bank through you, that even lowers the cost to the bank because they don't have to pay a third-party broker to originate. They just pay their internal cost, however they're rationalizing that. So those are some arguments to really keep in mind. I think it's a good time to get back into this, approaching local lenders. And as time goes on, more materials on how to make that pitch will be developed. But I think, like I said, I think it's a good time to go to start visits with your preferred product lenders as soon as you can.
Excellent. Thank you. And David?
Sure. Thanks, Bruce. And I'll be very quick. I think everyone has covered it very well, but I want to just leave a thought in everyone's mind. Our discussion and work in this space is not done. We've been reading about market disruption in housing finance, and clearly RESPA remains an open issue. The court remanded the standard back to the CFPB for further consideration. HUD is in the process of trying to update its guidance to all of us as housing counseling organizations. And further, we have a brand new CFPB. Externally, the Mortgage Bankers Association and the National Association of Realtors and other industry trade associations are also calling upon the CFPB to issue clearer guidance moving forward on the issue of RESPA. So this is going to remain an issue that we need to monitor and watch And as well, building on what Lot has said, as we develop these new form contracts, as we develop these new form approaches to market our services to industry, I hope that we can be transparent with each other to bridge concerns from industry so that we have a common standard and common approach to try to scale our programs, because fee for service is vitally important for us. And I just want to acknowledge NHRC's role and that of the Coalition of Intermediaries, as well, the Minnesota Housing Home Center, as well as Home Free USA, for all of the wonderful work to get us this far. It's been a Herculean effort, and frankly, also, we had quite a bit of pro bono assistance from some major law firms. Principally, the staff from those law firms were former CFPB staff, and that was very helpful as well. So, Bruce, I'll conclude with that.
Excellent. Fascinating stuff. So do we have questions in the queue, Matthew? Whoa, we settled it all out. So this will be an ongoing discussion. There's no question. We understand that these are complex issues for people. I really appreciate both Lot and David's points about engaging with lenders and walking them through how this can work in the future. Certainly, as we learn more, we will pass this on. And if people can choose, it'd be helpful if you elevate your experience with lenders to us so that we're able to hear what people are doing, and we can get more track record on this. At some point, we will re-engage with the CFPB along with the list of groups that David mentioned have been part of kind of a team. I'd add NeighborWorks to that list as well. A team of that has been really trying to engage with this issue over time. So very, very helpful to all of us. So on that note, let's pivot to an ongoing existing agreement that the New York Mortgage Coalition has negotiated. We have Rebecca Sen, and she was kind enough to share with us the agreement that they had worked out, and we sent that out in an email. I think it's something like New York Mortgage Coalition Lending Agreement, something like that as the title just this morning. So people have access to it, which I think is a valuable resource. So Rebecca, are you with us?
Great, thank you. Yes.
Great, thank you for doing this. So
yes.
Give us the big picture here.
Sure. So I'll just provide a little background information about the coalition so people know what we do and what our model looks like. We're a nonprofit coalition of approximately 14 lenders, the GSEs, the State of New York Mortgage Agency, and 9 HUD-approved housing counseling agencies located throughout New York City, Long Island, and Westchester counties. We're formed in 1993, so this is actually our 25th year of existence. We're also a HUD intermediary and have 12 agencies under that umbrella. And the Mortgage Coalition primarily functions as an annual dues-based membership organization where a lender pays annual dues based on their domestic assets in billions. And we then issue annual base grants to the housing counseling agencies and pay $500 for each housing counseling session that generates a loan through one of our lending members. And each year we generate approximately 400 loans, and in the past it's been upwards of 600 and 700 loans per year. And we do have a template agreement with our lending members, which Bruce is attached, which spells out, counseling responsibilities, bank responsibilities, and the homebuyer counseling fee to our housing counseling agencies. And this agreement was created with our own legal counsel and that of 3 lending institutions, some national ones and a regional, a smaller lender, and the review of HUD. So annually, it is reviewed and updated as necessary. And on our end, NYMC is composed of national lenders and smaller regional ones, and we have not experienced any concern over the recent PHH decision from our lending members, and they continue to do fee-for-service agreements with the coalition, which is a great sign.
That's great. And let's talk a little bit about what is contained in these in the agreement. Do you want to talk a little bit about the what the content is?
Sure. So we wanted to make sure that we really looked at Section 8 of RESPA and had a lot of that information in there. Section 824 CFR, I believe Section 3500, permits payment to an agency. So we made sure that we had that in there, and that the client will choose between comparable products from at least 3 different lenders. I think that was extremely important to have that in there, and we have that in the section under additional covenants. We spell out the counselor's responsibilities, the bank responsibilities, and the housing counseling fee, which is paid to the agency. It's pretty long, I won't go through the whole thing. It's 8 pages of documentation here, and we also go through the counseling responsibilities of the affiliate, which would be the housing counseling agency, and it goes through the home buyer counseling programs, what they should include. And we also include a client authorization form in there and a consent to transfer client information to the bank.
Yeah, and I think on the kind of the discussion we just had, the one thing I would add to this, if groups are looking at replicating this particular model, is the way that the referral or the opportunity to use a particular loan product is framed up, is that it's 3 loans, 3 different offers, including one from the lender that signed the agreement, and we think that was certainly a red flag in one conversation with CFPB, and groups may be better off simply saying referrals to it. And I think he said at least three different loan products and lenders. That not having it tied to a specific lender that had signed the agreement would be the one thing I would suggest that people looking at this model might change. But it's good. I think one of the things that's valuable here is also that it spells out the counselor and the counseling agency as an independent entity that is delivering the services, as opposed to somebody who's working for the lender, and helps define the kind of firewall of the relationship between the 2 institutions. And you've gotten lenders to sign on, I take it.
Correct. Yeah. So approximately 14 right now.
Uh-huh.
And we've been doing this for a long time. This agreement has been in existence for, I believe, 3 or 4 years, and we've obviously been following the PHH decision carefully, and to make sure that we update the language in these agreements as needed. And one thing that was really important is that we emphasize that payments are not on closed loans or commitments, that it's actually for the housing counseling session.
So we had a few questions come in. Somebody asked if you have a draft that they can duplicate. I will say that Bruce circulated it, but I don't know if Rebecca or Bruce or anyone else wants to kind of talk about how folks can use the agreement that we circulated, if that's something they can copy, or if how should folks look at the draft that we circulated, Bruce or Rebecca?
Well, it's really Rebecca's call because it's your intellectual material, but I think our hope is that you will share, let groups rip and run with it. What do you think?
Yeah, we did share it as a template, and I think, and also looking at that agreement in conjunction with the HUD document, model funding agreements and fee structures would be helpful. They also have a smaller agreement attached to that document that spells out a lot of the RESPA issues and requirements and such.
Great. And then somebody asked if the counselors walk the clients through the product elements.
Absolutely. Yeah. They're required to do that. If they go through loan terms, if there's down payment assistance with that product, interest rate, everything like that.
Great. That's all we've got for questions that have come in.
Good. And I think another innovation is that you've got a fee that goes to the intermediary. So on top of the $500, there's $50 that goes to the intermediary, which is, again, all about sustainability. I think these things are valuable. You also spell out that the client should not pay this fee, so that it's paid by the lender. Those things, I think, are helpful pieces in the pie. And I think we appreciate the fact that you're willing to share this this makes everybody's life a little bit easier to figure out how to do this. So are there, are some of the banks that have signed onto this not New York banks, but national banks?
They are, yes. And that's, I believe a few of them are, HSBC, Bank of America, Capital One, and until they went out of the mortgage business, and then smaller regional lenders as well.
Oh, good. Well, I mean, just knowing that some of the bigger lenders have signed on makes it easier to approach them locally as well. And I think one thing I think some groups are nervous about is how do you first go to a bank to talk about it? But it sounds like your particular model is that you already had them at the table. If they're part of your organization. Is that correct to say?
That is correct. Yes. Well, the Mortgage Coalition was actually formed, by lenders back in the early 90s. They all sat down to think of a way to address housing counseling needs and to fund housing counseling agencies. And to do that, they created the Mortgage Coalition as an intermediary to fund those agencies.
Which is great in the sense that it says that this is a document that has been both vetted and helped originated by lenders when you're talking with lenders. That's helpful. And I don't know if you're willing to be a resource if people have some more specific questions or would love some guidance from you.
Absolutely. Absolutely.
Yeah, and just one other question came in for you, Rebecca. Someone asked if you have a feel for how regulators have dealt with the agreement, given that it's been in place for a few years now.
Not off the top of my head. I know that it's never received any negative feedback from regulators. This has also been filtered through DHS and other agencies across New York State, but we've never had any negative feedback on it from regulators.
Well, that's great. This is very, very helpful. We deeply appreciate this. So we may want to have you come back for an update at some point, or maybe a broader conversation about these agreements in the future. But this has been very helpful. And thank you, especially for sharing the template, I think.
Sure, great. Thank you so much.
Good. Excellent. Thank you so much. So it looks like we will finish on time. I'm pleased. We were highly disciplined. That was great. And one quick thing just to note is that we're thinking about having a discussion about organizations and the issues around mergers and acquisitions, if they're acquisitions, but about organizations that in our community that either have merged with others and from the experiences or thinking about it. It's a topic that's been suggested to us by a few of our kind of leading thinkers in our business, and so I'm interested if there's people have knowledge and experience they'd like to contribute to it. We also are actively working on the Innovations in Housing Counseling series. So all you entrepreneurs out there that have got innovative programs, that it turns out there's a bunch of them. I still have a couple slots open to feature programs this spring, and we would love to have you involved in that. And we're looking for other kinds of high content dialogues that we can have. So let me know if you've got some things that you feel like would be helpful. I'm still struggling to get enough high quality information on how to counsel people with disabilities. I feel like this is an open space in our business. It's one where people are engaged a lot more than I think is recognized, but also not talked about, and would love to be a resource in that as well. So with that quick note, we've had a good start in our membership for this year for NHRC. So I really, really appreciate it. We had a great year last year, and I know this isn't easy times for organizations, and I deeply appreciate the fact that so many of you stepped up and joined and renewed. This is a major part of what our funding is, and we really appreciate that. So please, if you haven't joined yet, NHRC, go to our website and or email me personally. I'll be personally happy to send you the application and answer any questions you want. I'm personally involved in every membership, and we're exploring trying to expand the membership benefits again. So there'll be some more on that hopefully in a couple of weeks. But we will be glad to talk with you about becoming a member if you'd like. So with that note, our next call will be the first Thursday in March, which, if memory serves me, is the 1st. And we'll talk with you then. Thanks so much, everybody.